All right, let's get started. I've been really excited for this panel. We really have some of the world's experts up here on the financialization of mining, capital markets, impact on miners. A lot of very cool topics that we're going to dive into today. So first off for intros, I'm Bryan Wright, VP of Mining at Galaxy Digital. I touch a little bit of our soft mining side, our miner finance side. I'll turn it next to Ethan.
Thanks, Bryan. My name's Ethan Vera. I'm one of the co-founders of Luxor Mining Pool, and we do a wide range of software and services in the mining space. So been around the mining industry for 4.5 years now, and incredibly excited to see how far it's come. And the financialization of mining is one of the most exciting pieces in the space today.
Zachary Sepharadi, CEO and founder of Dalma Capital. We're an asset manager and investment bank. Multi-billion assets under management and advisory. Personally bought Bitcoin in 2011 and launched our first crypto fund in 2016. Continued to manage and advise on assets in the space.
Hey guys, my name is Leo. I'm the founder of Anicca Research. You've probably come across my writing a few times. So I published a lot of mining-related pieces, and especially on the financialization of mining. So this is something I've been thinking about for a very long time. We're also building Alchemy Protocol, a protocol where miners can issue contracts.
And I'm Juri Bulovic, head of mining at Foundry. On the mining side, we run the largest Bitcoin mining pool. We have equipment financing business, buying and selling units, and advisory business.
All right, thank you all. So I think to start off, I'd love to get a quick answer from each of you on just what's sort of the state of capital markets right now for Bitcoin miners, the state of the financialization of mining, and how has it sort of evolved, particularly over the last few years? And maybe we can even just go around and start with you, Ethan.
Sure. So I kind of see us on V3 of capital markets and mining. V1 was 2017 to 2019 era where for the first time ever, miners could access capital markets through public equity. And that really helped bootstrap a lot of the early companies in the mining space. Then starting in 2020, following into the next years, we started seeing debt markets really be unlocked, especially with innovations like ASIC-backed financing, which a few of the guys on the stage here do. And then heading into V3, which I think is really exciting, which will probably be the starting in 2022, but really taking off in 2023, is the financialization of hash rate-based instruments. So hash rate-based forwards, futures, and looking forward to picking Leo's brain on this panel later today to talk through it.
Zach.
So state of capital markets, I mean, we've got circa 30 publicly listed miners now. Majority coming to the market, or a large plurality coming to the market via SPAC mergers, some with RTOs, some coming into junior markets and uplisting. I think that the industry is still misunderstood by the capital markets. It's interesting, if you speak to some of the first miners that actually listed, they thought of themselves kind of as funds, right? They potentially wanted to do a Bitcoin ETF and realized that that was a step too far for regulators, so they decided to list a mining entity instead. And we actually look at miners in a lot of ways not as traditional businesses in the sense that most are listed. They don't have customers. They don't have a lot of employees. A lot of their funding is CapEx, not necessarily OpEx. And we actually do think that that initial ethos of these entities being really capital allocators, they are really closed-ended funds in a lot of ways that are listed in the public markets, and we think they should be kind of viewed and priced and analyzed as closed-ended funds as trading at either premiums or in some cases discounts to NAV. We think that the markets do seem to be price discovering themselves towards a model that actually reflects that, and looking forward to discussing our kind of views on that more, although maybe they're a little non-traditional from what many are thinking. We do see the opportunities for more miners to approach listings in the more traditional way. We also are starting to see cross listings. Obviously there have been a lot of uplistings onto the NASDAQ. That still is where all liquidity is. You get the much better pricing, much better liquidity. There's part of me that's a little bit nervous about too many miners being kind of under the scope of the SEC, what that means for the network. But that certainly is where liquidity is, and certainly capital intensive industry. capital efficiency is becoming as important or more important than the efficiency of your miners these days. So that's certainly where things are progressing, and would agree with the other points that were made.
Yeah, that's great. And I think we'll dive a little bit more into public markets shortly. But first, let's go Leo and then Juri. Quick comments on sort of the state of things today.
Yeah, so I think to zoom out a little bit, there are two vectors that we can use to generally measure the development of the capital markets for mining. One is the size of deployments of all various types of instruments, and the other is, like as Zach touched on, the capital efficiency of these tools. All right, so on the size vector, we've seen it has experienced massive growth since 2019. So just from my personal experience, when I was running a mining operation in 2019, it was impossible to get financing from these gray-haired guys, right? It's just very difficult to get even like a 2 million loan. Whereas today you see 40 million private loans get issued left and right. And on the second vector, which is the capital efficiency of these instruments, in 2019 you have to show up with a piece of your claim to your data center or use your land as collateral now. And even in 2019, the major players were still a little hesitant to issue loans backed by ASICs because the illiquidity of the machines. But now ASIC financing has become a pretty big part of the game, and loans have come down from like 20% of interest to 11, 12%. We see more recently. I think the next step is okay. In addition to loans, can we do convertibles? Can we do directly instruments that's directly priced based on the performance of the hash power itself?
And I would just add, looking back to 2017, and you're mentioning it was hard to get financing or a loan. It was hard to open or keep a bank account for not just Bitcoin miners, for any cryptocurrency-related business. So we definitely have come a very long way. I think also over time on the financing side, when Foundry launched financing in late 2019 and Galaxy, like at the time, I think we were among the first to do that, and now I think you have more than a dozen financiers in this space. You also have a couple of traditional financiers coming into space. They're obviously still testing the water, still learning about the ecosystem. So I see the positive trajectory, but comparing to 5 years ago, we definitely have come a long way. And I would just say, I do think that Bitcoin mining ecosystem and capital markets, I think, are and always will be slightly underdeveloped compared to the rest of the Bitcoin markets and ecosystem. And it just, people don't pay as much as attention, but I think those two ecosystems do need to kind of grow hand in hand. And if Bitcoin price grows a lot, that means that there's going to be a lot more also investment in the Bitcoin mining ecosystem, and a lot more players come in to offer products and services.
Great. Yeah, thank you all for that. I think that was a really good overview of sort of where we are today. I think, Zach, you brought up a lot of really interesting points on valuing miners, sort of like closed-end funds. We've seen the explosion of miners going public over the last year. Like you said, like 30 some odd. I think we'll probably see more go public in the near and medium term. What is the state of things? Why has that sort of been a strategy? And any other sort of interesting insights that you might have related to public markets and miners?
Yeah, well, interestingly, it does seem public markets are starting to cool off. A couple of the planned SPAC deals seem to have gone on ice. We think that probably as a result of some price correction, valuations not necessarily looking as attractive as they were. However, it really is a matter of perspective. We still see a lot of miners. If you look at things through the kind of closed-ended funds lens, miners trading at nice premiums to net asset value, which demonstrates that there is, it makes sense to continue to raise equity in the public markets, particularly again when you're on the markets that have that good pricing and liquidity. Which, as I said, it's NASDAQ all the way. I mean, unfortunately, that is the reality. As much as we'd like to see other markets be attractive and get good pricing, it's just not happening. In terms of, so we are starting to see deals cool off a little bit. Another trap that we see some fall into, and I'd love to be proven wrong on this, is doing RTOs. Unfortunately, if you want to raise capital in the markets, you want to be, and you look at this kind of closed-end funds lens, you want to be trading at a premium to NAV. You want to convince the market that by giving you additional capital that they're getting a good deal, and that's just not the case when you do these RTOs and you start off with crappy valuation. Why is anybody going to pay a premium for your shares? And then you need to use that equity that you raise to go out and buy assets. So if you're trading at a discount to NAV, it just doesn't ever make sense to raise capital. So that's we would advise any miner looking to go to the markets, hold out to be able to go for now the SPAC route, or hopefully in the future more traditional route to get to market. We think actually also direct listing can make sense. We haven't seen that really uptaken as much, but it could make sense with pipes or at the market offerings coming later on. If you're, but you obviously have to have a good business and prove yourself. One thing that does worry me about the capital markets and the future of the capital markets is I think that a lot of miners have overpromised. I think that some that are in the public markets are going to end up disappointing. And I'm worried that casts a cloud on the whole sector. I hope, again, that doesn't happen or that doesn't materialize. But we think that there is a material risk that that there are delays in machines that are already priced in getting delivered, or very likely getting switched on. The impact that has on pricing and whether that kind of clouds the entire sector. As we've seen, there does tend to be some correlation amongst miners. So hopefully, because obviously there are very good players out there that are able to deliver and will be able to deliver, we hope that they aren't punished as a result of those that have overpromised. But those are kind of a couple tidbits here and there on insights of the capital markets, if it were. One thing we'd also love to see, when we talk about the capital markets, we're kind of talking about equity capital markets. We'd love to see debt capital markets come alive. It's when that happens, obviously debt products are interesting and attractive for miners. We think that there is decent probability that some good miners could get good credit ratings, and we think that there's a possibility to get an offering underwritten by the right miner, but when that happens is a question. But that's something where I see potentially an interesting prospect in the future. These are capital and asset intensive businesses, so it should make sense in theory. In practice, you have a much more conservative investor base in DCM, so not sure when that will materialize.
I would love to jump into this topic of NAV because I find it incredibly interesting. So we track ASIC prices on our data website, and it's really interesting to match that up against the valuation of these miners. And I'm just like ideas racing through my mind as you're saying this. But if you look at the public mining landscape right now, the majority of miners are valued at somewhere between $300 to $700 per terahash of existing hash rate. So there is quite a bit of disconnect there between what you can purchase an ASIC for, let's call it $80 a terahash, to what you can get valued at in the public markets. So I think that's one of the reasons we've seen such a large appetite for there. But would love to hear all of y'all's opinion on what do you think is a better trading multiple in terms of that NAV, or if you think that is a good metric to look at for miners.
Yeah, and just sorry for those in the room that when we talk about NAV, we're talking about looking at the value of the assets based on their current market value rather than book value. So when you're looking at how many physical miners a miner might have on the balance sheet, instead of reflecting the book value, which would be depreciated, and obviously they have very aggressive depreciation cycles based on the accounting principles that are being applied, you'd actually value those based on what could you actually sell those for today. Then you also have to figure out how you're going to value infrastructure. Infrastructure is not as marketable. It's not as liquid to sell, so that's a little bit more difficult. But we kind of base that more on replacement costs. We estimate around $400,000 per megawatt. Obviously, there's a big range there. We've seen secondaries trade up to 2 million a megawatt. We've seen guys that can develop at 180,000 a megawatt. But when we kind of look at this NAV-based calculation, we are looking at pricing the miners on the balance sheet, pricing the amount of Bitcoin that sits on the balance sheet, pricing the infrastructure that sits on the balance sheet based on its kind of sellable price in the market today, rather than the book value, and then figuring out the value of the business. Now, we don't just look at the miners that are sitting on the balance sheet, but actually we look at orders of miners that are sitting that are in some way on the balance sheet. They're obviously being priced in. You have obviously some very large public miners where a large portion of their value is based on machines that are on order that are not delivered yet, and their profitability when they will be switched on. You kind of have to apply a discount rate to those that haven't been delivered yet. But that's kind of the methodology that we're looking at when we look at this kind of price to NAV basis.
So when I think about the question, why are so many miners going public? I do think partially it's because they can, and because they expect a big multiple on the hash that they have online, or that's not even online, because the market is pricing it like that. And I just wanted to give the folks in the room the sense of capital intensity of this industry, right? And in public markets, you get better access to capital. So we've done some analysis of all the publicly announced orders of new ASICs, and mapping that, based on at the time what the price per terahash might have been, and we calculated that miners globally will need around $3 billion just in 2022 to complete their orders. And then if you also look at the capacity that's been announced of about 5 gigawatts that miners are going to build, again, if you use some assumptions, that's another $1.5 billion needed to build that. So it's a lot of capital that miners need. They're thirsty for capital, and either through debt or equity is one way of raising capital more efficiently.
Yeah, thanks for that, Juri. And I actually think that's a really good way to pivot even into a next topic, a little bit away from just public equities, but to ASIC-backed lending. It was something that several of you talked about, just giving a high-level overview of the state of things today. Juri, you mentioned Foundry along with Galaxy were sort of first movers in the space among a few others, and it can be a really effective tool for miners because the industry is so capital intensive. Juri, maybe I can go right back to you. What is ASIC-backed lending? What's the state of things? How does Foundry sort of approach this?
Yeah, so that's a product where miners can raise capital backed by ASICs that are either already deployed on hashing or a future order of miners that has been placed. And I think today it's about a dozen financiers or lenders in the space. I think with Galaxy, NYDIG, Foundry being among the biggest. And like I said, there's probably a couple of smaller ones, traditional financiers that have entered the space. When obviously that as a product is very attractive to miners because they can use mining machine as collateral and then use the income from those machines, the mine Bitcoin, to repay back the loan. From the kind of position of a lender, there's a couple of things you have to look here. So when we analyze the deals, one, we do focus, and it's a little bit of cliche, but we really look at the team, right? Do they have experience? Have they built facilities before? Have they mined before? Are they trustworthy? How long have they been in the industry? And it's really, and I'm sure many of you here can relate, but how many times have I seen a pitch deck where I call it Trio Fantastico? You get three guys, energy expert, financing expert, and data center expert, never plugged in a machine in their life, looking to raise hundreds of millions of dollars to build hundreds of megawatts. That's very risky, right? No matter how experienced they are in their careers, mining is still a relatively new industry that's not easy to navigate. So that's kind of evaluating the team and their ability to execute. And then obviously the second and most important thing is really evaluating what will be the cash flow of these units and will they be able to repay the loan, and it really comes down to your expectations of how quickly the difficulty or the network hash rate will grow over the next 12 to 24 months. And finally, it's really looking to ways how can you as a lender mitigate the risk associated with a deal. So obviously, all the units are put as a collateral, but you have to look at, in case the price of that collateral drops, does the miner have some other units hashing that you can add as a collateral? And then you have to start looking at what is your default strategy, right? In case miner, for whatever reason, defaults on the loan, what can you do? And so at Foundry, one of the most successful deals that we've done are the ones that are for miners in a trusted hosting facilities that Foundry already has been doing business. And in a case of default, we have a tri-party agreement with a hosting facility as well, where we would take over the contract, we would mine with those units until the loan is fully repaid. And obviously that de-risks the deal a lot as compared to maybe units being in a country or at a site that we have no access to. It's really messy then to repossess the units. And then, mind you, even if you repossess the units, if they're not hashing, they're not really valuable to you. And obviously you can always sell them on the market, but you have to keep in mind, more likely than not, the miner has defaulted on the loan because probably the mining economics have changed. So even if you find a buyer, you probably won't get the price that you wanted to maybe make yourself whole.
Yeah, thanks for that. Ethan, do you have a few comments?
Yeah. We had a really fun weekend project a couple weeks ago, which I guess is what miners do on the weekends. Nothing better to do. But basically what we did was we looked back to January 2018 and looked at the S19, S17, and 19 as cohorts, and basically looked at January 2018 up until now, and basically mapped out what a ASIC financing deal would have looked like at the time using existing economics. So we could see how that would perform. And the analysis we drew is that under a standard loan of 65% LTV and 7-cent power, half of the financing deals for an S9 and S17 would have been under collateralized during the lifetime of their loan. That's mostly due to really decreasing mining economics during that period. Whereas with the S19s, there was very few months that actually happened. And the S19s are also the same period in which ASIC financing became prevalent in the market. And so the mining industry really hasn't experienced a market where ASIC financing is prevalent, and we're seeing very decreasing mining economics, in which case miners are getting liquidated or need to top up the collateral in their contracts. So I think that will be very interesting to see the next time that happens, now that miners have taken on this leverage. And I think the key takeaways here are, for the financiers, lowering the LTV to reduce rates. From a quantitative perspective, I think Juri touched on the qualitatives really well, but lowering LTV, and then make sure that you're financing very low-cost miners, which will ensure they're profitable. And then the analysis that we drew from the miner's perspective is make sure you're taking on a reasonable amount of leverage. I think some miners are getting a bit ahead of their skis on that. So somewhere between like a 0.5 to 0.7 debt to equity ratio, I think is adequate in this market. And I wouldn't go too much above that, just from a risk profile.
Leo or Zach, do you have any comments on ASIC-backed lending? Anything that Juri or Ethan said that you want to go off of before we switch topics?
Yeah, I mean, this is a very complicated product because, so as Juri pointed out, there's a lot of operational risk inherent to this modeling process, right? And also the revenue is incredibly difficult to model. So there is the difficulty risk, the spot risk, the fee risk. I mean, fee is a little bit less. And projecting into the future, 12 to 20 months, this return can vary in a very, very large range. And so there are no established scientific process for modeling this type of risk. I mean, there are certain frameworks that we can use, but all these frameworks are they have frictions, right? They have frictions to reality so at the end of the day, it really depends on who has a higher risk tolerance and how much a buffer you're baking into this process. So this touches on something I said earlier. Okay, the capital efficiency of these instruments. So I think we are definitely evolving towards the right direction. There's definitely more granularity into these modeling process, but even if we have a scientific process, which basically means that we have a closed form solution to modeling these time series, there will be inherent operational risk that sort of characterizes the black swan events.
And I just want to add, the also operational risk is not only on the borrower that they're going to build a facility on time and plug units, but if you're talking about the new order coming in, you could have delays in the order being shipped, which happens often, or the batch maybe is not as good, so you see a high failure rate. All those different things would potentially make the borrower default.
I think the points have been well covered. I mean, the one thing we would say is we advise borrowers on ASIC-backed loans. One thing I've seen, I think to the detriment of borrowers is, I mean, one thing I can lead a horse to water. I can't make it drink. When you hire an advisor, try to take their advice a little bit. But I think it's also important to hire advisors, run a competitive process, make sure that you're presenting things the right way, make sure that you're, entering into structures that are well advised. There is, this kind of, I think we're all, have this libertarian part of us that brought us into the space, and there's also this, no intermediary ethos. Or disintermediation ethos that there is inherent in crypto. And I think that pulls a lot of miners that should have advisors away from working with advisors, making sure that advisor is also, asking your advisor to get paid by the buy side or by the lender side creates a complete conflict of interest. You don't want them talking you into a bad deal. So, the one thing we would add is, we think that obviously we're going to eat our own cooking, but we think it is important to work with advisors who can help structure these deals, help get lenders to, compete to give you capital, but also make the job easier for the lender to be able to do a deal with you that's executable, that's, potentially in a market or with a structure that has been bespoke to your needs rather than, an off-the-shelf solution.
Leo?
Yeah, just more on this delay part. It's actually super fascinating, right? So miner economics is classic commodity production business, right? You have recurring costs and you get varied amount of these digital crops, and whose value is fluctuating. But this delay of new shipment of machines is a highly concentrated risk. It's almost like your relative distance to Bitmain, and this distance is an abstract sense, right? Your relationship with Bitmain, how prioritized you are on their client list, and also, your distance to their shipping center. Right? How long does it take for you to actually receive these machines? So this is a pretty unique type of risk that's not really. It's not really. You're looking at traditional commodity production business. You don't really see this kind of risk, and this is just a unique situation of like everyone is buying machines from Bitmain. So it'll be very interesting to see how Intel entering into the business, other players entering into the business, if that changes.
Thanks for that. So we just talked a little bit about risk. You were just talking about it, Leo, sort of in the sense of ASIC-backed lending, but it also comes into play on how miners can manage risk. And then even beyond that, what are the financial products that are available for miners today? What's been missing to date? What needs to be put in place to help miners? And Leo, I know you've thought a lot about this topic. Do you want to start, and then maybe I can hand it off to Ethan after that?
Yeah, I think a mining operation is super interesting because it sits in the intersection of traditional capital markets, right? You have access, as a mining company, you have access to the public equity market, the debt market, private loans, but at the same time, you're mining something that's entirely digital. And in some sense, like this is like Bitcoin is the anchor of a decentralized financial system, right? So there is still a wide universe of decentralized financial instruments, whether it's Bitcoin perps or other kind of just digital instruments that's backed by this resources that miner haven't really explored yet. So one thing that exists for traditional commodity producers, futures, options. It's a lot of times these energy guys come into Bitcoin space, and the first question they ask is, okay, how do I hedge this? How do I protect my margin? I really just want to lock in like 30% or even 20% of on top of my costs. So this type of instrument hasn't really existed yet. I mean, it's kind of obvious idea, but it hasn't really existed yet because, one, the modeling complexity of these type of instruments. So let's say a miner is selling 10 terahash over the next 30 days. So who's going to take the buy side, right? How do you model this? So if you have the equivalent amount of information as the miner, why don't you just mine yourself? So and these are the reasons that this type of instruments, although it's pretty obvious, that hasn't really taken off yet.
Ethan, do you have any comments here?
Yeah, Leo and I probably both sound like broken records. We've been talking about hash rate instruments for a few years, but I promise everyone they will happen, and Alchemia is a good example of innovation in the space. My view on hash rate-based instruments is that they're incredibly needed by the market. The ability to lock in a future value of your hash rate or sell that hash rate forward as a form of fundraising. And I think they will develop in various forms, both decentralized and centralized. This is a very nascent market. Hash rate instruments have never been built before, and nor has compute power instruments. And so it is going to take a few years to develop. It's going to take multiple companies, a lot of different parties engaging with it. But I think the end result's going to be very valuable for miners and investors too. In some ways, trading hash rate actually has a lot more physical ties than trading an asset like Bitcoin. It has ties to things like renewable energy development across America, or Moore's Law and the rapid technology advancement of chip production, or geopolitical relationships between China and Taiwan. And so there's all these very real physical world topics that come up that will determine the value of hash rate. And so I think it's going to be a very interesting asset class for investors and traders to engage with, which is very necessary to build this market to face miners who are trying to offload that risk. So I think in the second half of 2022 here with Alchemia and some other products, and moving forward, there's going to be a lot of innovation here that will allow miners the ability to hedge their future cash flow.
There are hash rate linked loans that are available in the form of offtake deals. They're not very popular. There are a couple lenders that will lend to you in Bitcoin, but the problem is, you're then short hash, and that's not a position a lot of miners want to take. They could have gotten lucky a couple times in the last cycle by taking those loans, but you're short hash and you're short the price of Bitcoin, and most miners see both of those going up for obvious reasons. But yeah, there certainly is a lot of room for development in that space. I think actually these offtake deals make sense as part of a portfolio of loans. I wouldn't bet the farm on an offtake deal, but it has been a useful financing instrument, for example, for other commodity extraction industries. Certainly, the gold mining industry has relied on these offtake deals as a way of financing development. So, we think that, again, for large-scale borrowers, as part of a portfolio of different loans, that they do make sense if they're well structured, and you can put certain protections in place, kind of optionality at both ends of extremes, because in reality, most lenders don't want to put you into a default situation. Another space that we see as important in developing, but it requires more of the equipment manufacturers to play ball, and actually it was alluded to earlier by one of the early customers of Intel, is getting financing effectively in some way, or better financing terms from the manufacturer, and that's what has existed in other industries, particularly industries where your manufacturer is providing you an income-generating, capital intensive piece of equipment for you to pay that off with some of the proceeds of the capital generation. And in most cases, those are supported by either EXIM financing or credit insurance. We think that's and that's how we can kind of get into single-digit loan pricing. We can get LTVs or a different perspective on LTVs from lenders, and we see that as being a way of. I mean, we have a similar view. The number that we arrived at was, and I don't remember when we struck the number, but before 2025, the miners need about $10 billion to invest. So just to kind of keep things going, and that's not a very aggressive extrapolation of where we are. So we think that will become an important part of the mix. It won't be available to a wide portfolio of borrowers, but most importantly, it requires the manufacturer to be on board, because in essence, they're kind of the central counterparty of the financing. Now, the frustration that we've had as the manufacturers, they see that it would be a great instrument, but they thus far have thought, well, we don't need to do that, right? Our customers are happy to pay us months in advance in cash, and if that customer isn't, then there's another 10 behind them that are. But the reality is that there are other manufacturers coming to the market. Some of those manufacturers have incredibly cheap capital themselves, and will be in a much better position to provide that financing to their customers. So as capital efficiency's importance is rising and will continue to rise in perspective of miner efficiency and electricity efficiency, we see that as becoming an important tool as the traditional trade finance that really has existed since the advent of banking. Actually, banking was created for trade finance. So if you don't know where the term bank came from, it referred to banca, which was bench, which was where the bankers sat in mercantile Italy and provided loans to people that went on trade finance missions, or that went on trading missions, sent a ship to go buy spices. So that's a lot of where banking came from, and where we see hopefully the industry going in the not too distant future.
Thank you all. Those were great answers. So we have about 5 minutes left, and I'd like to end sort of similarly like how we started, go around and not talk about the state of capital markets and financialization, but where are we going next? If we think about maybe the next couple of years, what's on the horizon? And we'd love a quick answer from each of you. Maybe we can start with Juri this time and come back this way and end with Ethan.
Yeah. So I think we're going to see a lot more players coming into the space just on basic pure asset-backed financing. I do agree that hash rate, spot exchanges, future exchanges, all those products, that's cutting edge. I'm glad people are working on it, building it. I think it's going to be some time until that actually becomes predominantly used by miners. But I'm also very excited just about simple basic financial products and services that miners are still not taking advantage of. So whether you're simply holding onto your Bitcoin and not selling as a miner, whether you can earn yield on that Bitcoin, or if you're selling your Bitcoin, are you getting the right price? Or you could sell future and capture some spread. So there's a lot of simple financial products and services that miners to date haven't been really taking advantage of, and I think over the next 12 to 18 months, I think many will start to do that.
Leo?
Yeah, so I'm very excited about Bitcoin native DeFi, and I think this is in several years this is going to be much more important than equity and debt universe that we're playing around here. But like I said, I think Bitcoin mining company is in this unique position of intersection of both worlds, right? On one hand, it has the access to equity and debt market. The other hand, it has all these toys that they can play. So I think kids this generation, kids growing up right now, when they're not gonna, they think differently, they dress differently. They're not gonna come to this game and start thinking, oh, how do I play with equity or debt? They're going to play with all these toys that are fully digital native. So I think of all the things that we see today, yeah, Bitcoin mining company is the only thing that really have the share characteristics. So I'm very excited to see all the toolkits that Bitcoin miners have access to over the next few years.
So there are many things that I could touch upon. We touched upon a few. I think Juri also made a good point on kind of treasury management and those kind of solutions that are fairly simple, but that more miners should be taking advantage of, and will help them institutionalize and be kind of less speculative and ultimately grow and be more efficient businesses. One that we didn't get a chance to touch upon that I hope to see more of and expect to see more of is M&A. I think that one of the challenges with M&A historically was this kind of valuation differential in the mindset of the buyer and the seller. The seller kind of wanted to look at their best kind of comp set and say, hey, I'm worth, however much based on this, EV to EBITDA or this forward EV to EBITDA or this EV to pay to hash ratio, using Marathon as a comp or one of the kind of more expensive looking mining businesses. But then the acquirer, you look at the acquirer's perspective, they don't look at it like that at all. They're not going to look at public comps. They're going to look at, what are your assets worth, right? You have this many machines, okay, that's worth this much to me, or I can buy it in the market for this price. You have this much infrastructure, okay, how much does it cost me to build that infrastructure? You'll get a premium for the kind of opportunity cost of your infrastructure being online today versus developing it. But I think this was has historically been the problem with the kind of valuation gap between buyers and sellers, where also looking at other industries where M&A makes sense, there's no kind of efficiency gains, integration. It's not. So what's valuable about M&A is getting bigger. Right, being bigger, and ultimately the bigger players will have cheaper sources of capital, and the large players, that are highly valued will have effectively the cheapest capital versus the smaller players. Now we see, hopefully, now that miners are being priced more closely to NAV, that will start to unlock M&A, where there's not such a huge gap between the mindset of where the acquisition is accretive to the buyer, but also makes the seller happy that they've made a good return for their investors. So hopefully we see more M&A happening in the future, and on integrated businesses rather than just infrastructure, where but it does require, at the end of the day, you need two parties that can do a deal, right, and can agree a price, and that's been a challenge historically.
Ethan, do you want to close this out?
Yeah, I think we just ran out of time, so I'll be quick. Of course, we're excited about hash rate-based instruments. It's something that Luxor hopes to build and help facilitate in the future. So I think that's one area that quite a lot of excitement on. The second area I want to touch on is the geography in which can access financial markets. While we're all here based in the US and Luxor is a US-based company, we think it's incredibly important that other regions of the world gain access to these products. If we continue down the path we are now, where only American and Canadian-based companies are getting access to all these products, we're going to be in a situation where there's too much hash rate in North America. And we think that the South American nations, European, Asian, and elsewhere really could benefit from this capital. And so going to be trying to spend more time with capital allocators, educating them on the space, and hopefully finding the right risk-return profile for them to access these markets.
Well, thank you all. You all shared a lot of awesome thoughts. We've matured a ton, but there's still a lot left to build, and I'm excited for what's next.
Awesome, thank you.
Thank you.